What's up, you guys? It's Graham here, and you better brace yourself for what's about to happen. In a very short amount of time, we're about to see some significant changes throughout our entire economy. From the introduction of tariffs, upcoming price hikes, less consumer spending, and the one thing that everyone seems to be worried about the most, a recession. That's right, over the last few days, the odds of a recession have officially doubled, going as high as a 50% likelihood of happening in 2025. And if history is any indication, this is going to have serious consequences for everybody watching. Because like it or not, this is going to have a direct impact on everything, from stocks to housing to cryptocurrency to even Jim Cramer's buy and sell recommendations. So with uncertainty having spiked to levels only seen once since 1995, let's talk about exactly what this means, the impact this is going to have on all things money, how this is going to change the future of our economy, and then most importantly, how you could use this information to come out ahead profitable on today's episode of Always Make Coffee at Home. Although before we start, if you appreciate videos like this where we just cover the unbiased facts, regardless of what side you're on, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. I know I'd prefer not to ask for it, but you know what? It does help out the channel tremendously, and as a thank you for doing that, I will do my best to read and reply to as many comments as I can. So thanks so much, and also a big thank you to ZipRecruiter for sponsoring this video, but more on that later. Alright, so in terms of where to start, let's begin with the topic that everybody is worried about, a recession. Now, even though this is technically defined as 2 consecutive quarters of declining GDP, what most people don't realize is that more than likely, you're not going to know you're in a recession until it's already too late. Believe it or not, throughout the last 6 recessions, there's an average lag time of 7.3 months between the time a recession takes place and the time it's actually announced. This means if we're in a recession right now, the mainstream media is not going to be telling you about this until November. Why does it take so long, you might ask? Well, in order for a recession to be confirmed, it needs to be announced by the National Bureau of Economic Research, who doesn't just look at declining GDP, but also they want to see a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in production, employment, real income, and other indicators. Or I guess in other words, they're not going to tell you we're in a recession until they know 100% we are in a recession. This is partially why you have investment banks like Goldman Sachs issuing their warnings ahead of time, saying that they might see a recession on the horizon, which reflects their lower growth baseline, the sharp recent deterioration in household and business confidence, and statements from White House officials indicating greater willingness to tolerate near-term economic weakness in pursuit of their policies. JP Morgan also agrees with this, while 95% of economists polled said recession risks in their economies had increased as a result of Trump tariffs. After all, it doesn't take a genius to start to see that Americans are spending less money, business activity is declining, first quarter GDP has already fallen to just 0.3%, estimates for future GDP come in at negative 2.8%, and so far, nearly every indicator is beginning to point to the fact that a recession is looking more and more likely. Even anecdotally, I can tell you that I'm starting to see a lot of people scale back, investors are becoming a lot more cautious, some of the wealthiest people I know are taking some chips off the table and putting it in cash or money market accounts, and if there's one thing the market absolutely hates, it's uncertainty. Although in terms of how long this could last, I hope you're sitting down. According to the data, since the 1940s, we have seen 12 recessions. The longest lasted 18 months, the shortest lasted 2 months during the COVID shutdown, and since 1900, the average recession tends to last about 10 months, with usually not so great effects. For example, the Economic Policy Institute found that during recessions, we tend to see a complete contraction throughout the entire economy, starting with first, job losses. As companies anticipate lower earnings, they'll seek out to cut costs, with usually unemployment beginning to rise. 2. Alongside that, we also tend to see declining wages. For instance, a study in 2009 found that the average worker saw a 6 to 7% income loss for every 1 percentage point increase in the unemployment rate. And even after 15 years, the loss is still 2.5%. And 3. We also tend to see less private investment. However, when it comes to actually making money from a recession and using it to your advantage, take a look at the stock market. In terms of where prices could be headed, here's where the research tells us. During the last 11 recessions, it was found that stocks have tended to peak 8 months prior to a recession and declined by approximately 30% on average, meaning if peak stock market were sometime in February, a recession wouldn't be official until November, putting us precisely in line with the average 7.3-month delay. However, when you dig a little bit deeper, there is some good news, or some bad news depending on how you look at it, and it's this. A recession by itself has very little correlation with how the stock market performs. And yes, I was surprised about this data as well, but here's what I found. From 1869 to 2018, there have been a total of 16 recessions that had positive stock market returns. And of those positive returns, the market went up by an average of 9.8% during a time that GDP declined by 3%. Or in other words, out of 30 recessions from start to finish, they had zero correlation whatsoever with lower stock market values. And even when you account for the COVID crash, the market still went up by 1.7% on average, implying that stocks were consistently a good investment. But with a bit of a twist. Even though stocks were, on average, positive from the start to the end of a recession, that didn't mean there weren't significant drops in between. And as you could see, the typical drawdown was still 29.2% before prices eventually recovered. From there, once the recession is over, it was found that after a year, you would have made money in 85% of the cases, and after 3 years, you would have been in the green 100% of the time. This means that investing during a recession is one of the most profitable times to buy in, because once the bad news goes away, investors put their money back, causing prices to rally as usual, and the longer you hold on for, the more likely you are to come out ahead profitable. But does the same thing also apply to the housing market? Although before we go into that, I just want to say this because it's important. I have been very fortunate that over the last 6 years, I've slowly built out the right team who helps optimize these graphics, edits shorts, coordinates outreach on the podcast, and handles all the back end that keeps things running smoothly. Without hiring the right team, I guarantee I wouldn't be here today. And if you find yourself in a similar position and want to surround yourself with the right people, then our sponsor ZipRecruiter is there to help. They make hiring fast and easy so that you can get back to what matters the most. Smashing the like button. No, just kidding. Actually growing your business. In fact, 4 out of 5 employers who post a job on ZipRecruiter find a quality candidate in the first day. And if you're curious how it works, it's really simple. First, you post your job with just one click. Once it's live, ZipRecruiter sends it out to millions of job seekers. From there, ZipRecruiter's matching technology gets to work. It scans thousands of resumes and finds the best candidates for your role, inviting them to apply right away. On top of that, you could also invite your favorite candidates to apply using a pre-written, personalized message, boosting your chances of getting them on board. And then once you start receiving applications, ZipRecruiter's easy-to-use dashboard lets you review, rate, and sort candidates so you can find the perfect fit. Alright, now in terms of how a recession impacts the markets, let's talk about the one that everyone is curious about the most. Housing prices. To start, let's get some of the big news out of the way first. Besides the great financial crisis and a brief period in the 1990s, believe it or not, housing has been one of the best hedges against inflation, having increased nearly each and every year regardless of the economy. Why? Well, typically, interest rates fall during a recession, and when that happens, buyers are able to qualify for more of a loan, driving back up home prices. On top of that, if there's a recession, the majority of homeowners are already locked into low-rate mortgages, making them unlikely to move. And since 40% of homeowners don't even have a mortgage, this means there probably wouldn't be a bunch of panicked sellers all flooding the market at the exact same time. To me, I think the best analysis was posted in 2023 by Mark Woodworth, who noted that in order for housing to fall, there would either have to be a significant reduction of demand or a significant increase in inventory. And in terms of how much it would take, demand would have to fall by 50% just to be in line with historic averages. Although he says this is unlikely given that transaction volume hasn't fallen below 2 million since the early 1980s. Alternatively, housing supply would also have to double, which theoretically could possibly happen, especially for those who have a mortgage rate above 6%. But it'll take some time. For instance, in terms of how this could happen, Mark explains that a large portion of inventory was bought by individual investors, and as the market price increases relative to rent, it could prove to be a profitable exit point to sell. This could also extend to those who bought Airbnbs, those who bought a property simply because property values only go higher, or those who tried to flip a property for a quick profit. Or it could extend also to those who have their insurance or property taxes increased by a lot over the last few years, even though that one could be a bit more localized. Now, separate from that, the same phenomenon also occurs with rents. Even though it seems common sense that rents would be going down during a recession, as it turns out, the opposite is actually true. Rents stay the exact same or even continue going higher since few people could qualify to buy a house. All of that's to say that the housing market's a lot less volatile since people take a long time to move. Homeowners are reluctant to sell during times of economic uncertainty. And outside of certain local markets, the most likely outcome is really more of the same. In fact, as Ben Carlson points out, home prices have only ever fallen for 7 years out of 50 in total, with 5 of those years being isolated to the subprime mortgage crisis of 2008, of which isn't a concern anymore. This is why CoreLogic believes that home prices will increase another 3.6% year over year, Zillow thinks that we'll see a 0.6% increase, and Redfin forecasts a 4% return, especially since the top 1% have the wealth to buy 99% of homes. Although, in terms of what I think of this and what this means for you and your money, you're going to want to listen closely. Look, I've said this before recently, but I'm going to say it again because it's important. I believe tariffs have become a very long-term negotiation strategy, and short-term, it's absolutely going to be extremely volatile. If you're new here, this means that Trump threatens tariffs to start in 30 days, the other country says they'll retaliate, the market drops, 30 days later, Trump either gives a temporary extension, in which case the market goes up, or Trump follows through with his tariffs and the market goes down. Other country then retaliates with their own tariffs, so Trump doubles his tariffs as a punishment, the market goes down even more, 24 to 48 hours later, a temporary agreement is reached, and then the market goes back up again. As proof of this, just recently, Israel just eliminated all tariffs on US products to avoid our reciprocal tariffs. And I have a feeling other trading partners are soon going to follow suit, but a few are going to hold out, and it's going to be a very bitter back and forth, probably for the rest of the year. But in terms of buying back into the stock market, history usually shows that it's extremely profitable. Like, just take a look at this article from the Motley Fool. They reported that since the 1940s, there have been a total of 48 stock market corrections of at least 10%, which works out to 1 every 20 months. And of those, only 12 fell into bear market territory. From where we stand right now, with the exception of 2008, with only 2 exceptions, stocks were higher a year later, and 60% of the time, stocks had recovered within just 3 months. Separate from that, it's also important to understand that anytime you look at market returns, the average very rarely happens. And in most years, you're either going to make or lose a lot of money. For instance, as the Wealth of Common Sense blog pointed out, who I'll link to down below in the description, the market has only returned between 8 and 12% a year, 5 times since 1926. That's it. Or basically, the stock market going up 8 to 12% happens just as often as the market going up by 40%. Not to mention, even more absurd is only 18% of market returns have been between 5 to 15% in any given year, and it's more common to see double-digit gains or losses in a single year than it is to see the market average. This is why it's generally suggested that when you're investing, you need to have a long-term outlook of decades and not just months or years, and don't be fazed when you either make or lose a lot of money. All of this means that if we end up seeing a recession this year, the biggest concern isn't so much what happens to your stock, crypto, and housing market portfolio, but rather your ability to stay employed and keep a consistent income so that you could continue buying in as usual. I know that sounds very simple, but realistically, that's the biggest concern for 99% of people. And if you could just do that, if history is any indication, you're going to come out ahead quite profitable in the long run. Oh, and by the way, apparently my videos are so unbiased that you had people thinking that I voted for Kamala or Trump in the exact same video. It's the same information, just depends on how you listen to it, apparently. So if you appreciate that I truly just try to stay in the middle and talk about the facts, and that's it, again, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. And don't forget to check out our sponsor, ZipRecruiter, down below in the description for any of your hiring needs. I highly recommend them. Thank you so much for watching again, and until next time.